And then by 2009, if we look at, let's say, yeah, unemployment rose. Unemployment did not rise though because of the exact housing market. Of course, it did have an effect, but it was because of these banks. I mean, think about it. Two of the biggest banks in the world went bankrupt. And can you imagine the amount of jobs people lost that were involved in these banks and the people who worked with the banks that lost their jobs because their biggest clients were the banks? It's not a good scenario. And GDP was negative, a recession in 2009. But look at this. Inflation rose a little bit. But look at what happened in 2009 when it went worse, when unemployment went up, when GDP was negative, right? A whole indication for people to sell in the market. What did the market do in 2009? In March, it bottomed and it shot up for a year. See, the market is not the economy, even though there's a recession. I can't even imagine the amount of people that were expecting a recession over here. Same damn thing what everyone is thinking right now, right? But if you look at the markets now, what do you think is going to happen? I don't know what's going to happen, right? And I know this is going to create a lot of people are going to say, yeah, but it's a different scenario, what, blah, blah, like all the excuses all the time. But for crying out loud, we've looked since 1928, all the same events, all different events. And just by probabilities, the probability is low that the market's going to come down because I don't even care what's going to happen. I don't care how bad economically it's going to happen because the market's not the economy. It's not. It anticipates it already. I don't care if the economy is going to do bad next year. Why? Because it's not, the market's not the economy. And even if it does so, I'm going to buy it at a cheaper price. Yeah, unemployment in 2010 was at 9%, but the market shot up. The market stayed still for a bit during this time, and then it went up. And let's see. During 2010. So in this part, I really want you guys to pay close attention because now we're in a decade, right, where in 2010 and what went on after 2008 really reflects on the cause and effect. And if you understand the stuff, you're going to understand the position that we're at right now. So I want you to play close attention so you won't have confusion that another person's going to tell you something macroeconomic and then you're going to sell based on that. No, I want you to understand what's going on now on 2010 and 2009 because it does reflect what's going on right now because everything is a cause and effect. So with fiscal policy limited our long-run federal debt challenges, monetary policy makers took action to address the lackluster economy in 2010. In earlier November, the Federal Reserve announced a plan to purchase $600 billion of longer-term Treasury securities by mid-2011. The plan has come to known as QE2 because it represents a second wave of the Fed's so-called quantitative easing program, the first installment of which involved purchasing up to $1 3/4 trillion in longer-term assets during 2009 and earlier 2010. QE2 was not a big economic activity event in the sense of being exotic for some time. The Fed has not been able to increase monetary stimulus by lowering the short-term federal funds rate. Its traditional policy lever, as that rate has been close to zero since late 2007, which is interest rates. And then the next logical step has been ease, or at least it's a part of interest rates, and lowering still longer-term interest rates. Purchasing longer-term assets simply a means to that end. In 2011, you had Black Monday, which was, I'm pretty sure it's here. Something happened. So on Black Monday in 2011, refers to August 8th of the, look at this. You see, you're going to always get this. The U.S. and global stock market crash. Let's see what happened. Okay, yeah, this little drawdown. Let's see what happened. Some dumb issue. All right, so following the Friday night credit rating downgrade by Standard & Poor's of the U.S. sovereign debt from AAA or risk-free A to AA+. It was the first time in history the United States was downgraded. Moody's issued a report during morning training which said their AAA rating of U.S. credit was in jeopardy after issuing a negative outlook in the previous week. So there was a big U.S. sovereign debt. And, well, actually, no, the credit rating was downgraded. So a credit rating is the evaluation of a credit risk of a prospect debtor, predicting their ability to pay back the debt, and an implicit forecast of the likelihood of the debtor defaulting. The credit rating represents an evaluation of a credit rating agency of the quantitative and quantitative information. Basically, Moody rate the U.S. sovereign debt, and they downgraded it, which means they're more likely to default in the debt. Yeah, it was a macro event. Many people got scared of that, I'm pretty sure. And this is still actually an issue of the debt ceiling. So the U.S. debt ceiling was a financial crisis that started as political and economic debate over increasing the statutory limit of U.S. federal government borrowing. The limit of the indebtedness of the government of the U.S. is also known as the debt ceiling. So basically what it means is that the limit of not acquiring debt is known as the debt ceiling. In the run-up to the crisis, the U.S. had approached and actually passed that limit. So basically what that means is that the limit in where they see that they can't go with more debt, they broke the limit and broke the rules of going through that threshold of the amount that the debt that they should have. And that's what's going on right now. Meaning that the more likelihood that the U.S. will default in that debt. That's why many people are giving this stupid, that's a big concern right now. It's the same thing that's going on right now. People are very concerned because of the debt ceiling of what's going on with the U.S. But that's very black and white. Because just because there's a debt ceiling does not mean that the economy is going to come down or whatever. There's still ways to resolve this. And that depends what the Federal Reserve does. I can't do anything about it. No one can. The Federal Reserve has all the power to do that. Not even a president. Sure, a president, but the thing about presidents and that you have to understand is that a president is just a figurehead. People who make real decision is Congress, Senate, and the Federal Reserve. They're the ones who control a lot of the things. The president can give an idea and a movement of what they want to do, but at the end of the day, who's going to make the decision is Congress and Senate. So the U.S. Department of the Treasury had no authority to issue or incur debt beyond the debt ceiling set by the U.S. Congress. Failure to reach an agreement between the necessary members of the government to raise the debt ceiling, meaning that certain debts would not be paid, and this would potentially affect the government's ability to borrow quickly at a low cost. So basically, to get a loan or to get a leverage with lower cost, that lowered the effect, that lowered the probability, and hence increased the risk in loaning money to the U.S. And that was the problem. Many people got fearful for that because they probably thought that many other countries were not going to lend money anymore to the U.S. because of their breaking of the debt ceiling. And I can already imagine Wall Street like in this time. If the debt ceiling, the news reporters, and if the debt ceiling were not raised by August 2nd, 2011, either government spending would have to be decreased or debt would have to be paid later than promised, also known as a default. Many people were worried that the U.S. was going to default, or whether the spending of the government would be decreased, which would obviously decrease the economic activity in the future. This is important because this reflects on what happened in 2016 and also reflects on what happened politically. See, a lot of things are moved by money. Many people don't understand that. They think that it's different things, but you'd be surprised that the world is so dependent on money. That's why it's important to be financially independent. It's important to have money because you get to control things a lot because the world runs on money. The debate was continuous with nearly all Republicans legislators opposing any increases in taxes and a large majority of Democratic legislators viewing tax increases as necessary along with spending cuts. So this debate was a big debate, and that made all Republicans legislators wanting to oppose an increase in taxes, and a big majority of the Democratic legislators viewed taxes increases as necessary with cut spending. Supporters of the Tea Party movement pushed Republicans to reject any agreement that failed to incorporate large and immediate spend cutting or completed balanced budget constitutional amendments. This is interesting because this is where you start to see why presidents did things they want to do. But again, a lot of people don't even know this stuff. When you hear a politician shouting, many people shout with them. The immediate crisis of 2011 ended with a complex deal imposing limits on both debt and government spending was reached on July 31st. So basically, Congress and the Federal Reserve wanted to cut spending. They wanted to raise the debt ceiling by increases in taxes and all these other things. I don't think that's more like micro effect. I don't think a lot of this stuff is relevant. I think what's more relevant is actually what they're gonna do in the Federal Reserve. When a complex deal imposing limits on both government and debt spending was reached on July 31st, after the legislation was passed by both House and Senate, Barack Obama signed the Budget Control Act of 2011 into law of August 2nd, the day of the deadline. However, because of the political upheaval and the perception by powerful credit ratings agencies that the U.S. government cannot effectively manage its large debt position, like the Moody's and the S&P 500. What was it? The S&P 500 downgraded those AAA debts, and that made everyone in Wall Street panic. And when Wall Street panics, a lot of other people panic because they're the so-called experts. And instead of following the downgrading of U.S. sovereign debt, as well as the Fannie Mae and Freddie Mac, government-backed lenders by the S&P from AAA and AA ratings, the global stock market experienced a prolonged period of heightened selling activity, ultimately resulting in the crash of Black Monday. So people were scared of the debt ceiling crisis. That's what made the price go down. Despite that, everyone who sold here, the market bottomed over here. No one expected it, and the price went up. And it kept going up. That's why you shouldn't listen to Wall Street. You shouldn't listen to what happens geopolitically and macroeconomic. That's not how you invest, because markets will go up and up and up and up. Now you might be saying, but how is that so? Isn't that a big issue with debt and all and what's going on? Yeah, but it's a rating. It hasn't happened yet. Is the US defaulting? Are they actually defaulting? Are they in those debts, or are they increasing the debt ceiling? None of that has happened yet. It's like people are worried on things that even haven't happened yet. That's a bad way to live about in life. I mean, you're panicking about something that hasn't happened yet. It's like a child when someone goes to date and then they start to worry about the possibilities that the person isn't going to like them, or whether they're going to like them, rather than just taking action and doing it. It's the same thing. Many people get scared over a little shove when a person trips, and many people start to panic. It's hilarious. And by 2013, see, the economy grew. Why? Because all those people yelling about 2 years ago, none of that stuff was happening yet. It wasn't happening. And plus, it was just a rating. It didn't happen yet. It's just a probability. That's why it's a rating. It's not a result of what it's a rating that the US government is likely unable to default, right? But that's why it's a rating. They were downgrading it because of the possibilities of a risk that the US was likely going to default in its debt. But has it happened yet? No. That's why I'm saying that this could be reversed, because in the Federal Reserve, they can control the economy into ways where they can stop the amount of debt. That's what happened in the 80s. Remember, with that debt depreciating the dollar, you can make programs to, while time goes on, to bring that debt down, right? But no, many people got scared. They thought it was going to be the end of the world and where the US was going to default, and that was going to lead to the decline of the empire. And I'm pretty sure everyone started to watch documentaries about how the US is going to, Illuminati's, blah, 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 blah. So this is what people do. And the markets went up for 3 years. Employment fell to 7%. Unemployment fell by 7%. And manufacturing jobs were rising, the biggest since the 80s. See, this is why I tell you that, did anyone in 2011 wouldn't even imagine that 2 years later, jobs would be up by 500,000, unemployment would drop by 7%, and economic growth would be at 4.1%, the highest since many years. See, that's why, because it hasn't happened yet. Right? But many people get scared of what happens. That's why you have to look at things. You can't listen to someone and hear them say that a recession's going to happen and all this. No, first of all, don't listen to anyone. Look at the facts yourself, right? And ignore whether people like you or disagree with you. You have to stay with the facts, because that's the sole reason how you're going to make money. You're not going to make money because another person's going to tell you recession, and hence it's going to be safer for you to hold your assets and wait to buy again. That's stupid, because that's how they make money, by selling you information to do that. And even to me, you can listen to what I'm doing, but you have to understand, just because I'm saying something does not mean that you should invest into it. You have to do the research yourself. Even if Warren Buffett says something, you can't do it just because he said it, right? If I tell you tomorrow that if you invested into a business, and I tell you, why did you invest in that business? And if you tell me because I said it was a good investment, I'm going to look at you strange and I'm going to be disappointed, because that's not how you should invest. You need to do due diligence. I understand that a lot of people do this because they don't understand, because of ignorance, but try your best to understand what's going on. And guys, let me give you something. Did you really think when I was starting in the stock market that I knew all these things in a batch? No, I don't. No one does. Not even Steve Jobs, not even Elon Musk, right? When you get good at something, it's not because I'm talented or none of this stuff. It's because I did things that I didn't know. I learned things that I didn't know by constantly researching about it, by listening to people higher than me. That's what I want to give to you guys. I want you to listen to what I'm saying, but I don't want you to accept it like if it was a religious die to know. No, that's not how you get wealthy either. That's a bad way to look about things. You need to look at things objectively, like a scientist. From what he's saying, there's a probability that will happen, but I will take it as a consideration. But what he's saying does make sense, or what she's saying does make sense. Let's look about the research of what that is. And if many people think that if that comes up to be the same thing, well, that's something, go towards a better probability, right? And that's what I'm trying to say. So the economy was doing well, really, in 2013. By 2014, okay, it was a very strong year of U.S. labor. And after sluggish first couple of years of the recovery, in which the economy momentum finally picked up as it looked poised to be on a more self-sustaining path moving into 2015. It's funny because people in this decade, I've noticed people become so uncertain of what's going to happen because of what happened in 2008. And that's still going on right now. Many people don't even know what's going to happen, most of all because of the debt ceiling, because of the strength of the US compared to China, potential threats of power, companies more involved with China that are powerful in terms of technology. It's very funny the decade that we're living, but that's complete nonsense, because In fact, I think it's going to make a huge growth towards the US. Because when you have competition, you give variety to people. You do. You give variety to people. What do you think is going to happen when China does so well in technology per se? What do you think the US is going to do in response? They're going to invest a ton in technology, and their technology products are going to go up. And so is China. When they see this, they're going to see they're growing, their technology is going to grow up. I think competition is such a great thing to have because it's going to boost a lot of productive values up, and it's going to produce and enhance the investments you currently have. So by all means, the mentality that I have, I believe China and the US should always have a competition with each other. But I'm not saying I don't like wars. Wars are not productive. Wars happen when you don't understand something. It's like a fight with your family or your spouse. It was led because you both didn't understand something, and after it happened, you both understood something you didn't know. And after that, that potential war reason isn't going to happen again. That's what happened with Nazis. The chances of another Nazi to come in is very low because they've learned what they didn't know before. That's the same thing with the economy. There was monthly job growth in 2014, the strongest since 1999, and unemployment rate is down by 5.8%, the lowest since mid 2008 and almost 1 percentage point lower than 12 months ago. All right, so the economy was growing 2014. Then by 2015, let's see what happened. There's always, let's see. Okay, wow. All right, it was very sluggish. Let's see what was the cause of this. Are we repeating? Okay, this was 2020. All right. By 2016 or 2015, the U.S. economy was slow, that several historical reliable indicators of an imminent recession were waving red flags. Industrial production was negative over 12 months, and retail sales growth was falling, and the global economy was even weaker. This is exactly what happened in 2022. People were getting fearful. That's why I'm laughing, because people are entering into a stage that they're so worried from one little thing that happens, and it pushes what they do. Because nothing has much happened since 2008, but it's because we've learned from those scenarios. We're in a different cycle now. We've had 2 crashes in the banks in the .com that we don't happen to happen again. But that's like absolutely worrying that you're going to die soon when you are going to die, right? It's that mentality. No one wants to die, but you're going to die soon. It's a funny scenario what people have, and it's the same thing that happens here. Everyone is worried over a little effect economically, when in reality, you're always going to have a crisis eventually, because it's inevitable to make mistakes. When a mistake happens and you make another mistake, the mistake of a battered decision and the consequences in bigger effect than later. So if you were to ask me if a recession will happen soon, recessions always will happen. Depressions will always happen too. They happen less likely than recessions, but they do happen. I don't know. I mean, I can't give you a measure, but I could give you maybe every 50 years. I don't know. I mean, we haven't had a depression since the Great Depression. But can that happen again? Yeah, absolutely. I don't know when, but it does take a lot more compiling consequences for that to happen, right? Can a Great Depression happen tomorrow? No, that won't happen, because there has to be reasons for that to happen. Can a recession happen tomorrow? No, because there isn't sufficient amount of reasons to even have a recession. So the only reason why people are saying right now that there's going to be a recession is just because there's a little indicators. Like, for example, there's the contraction in PE, and people are worried that PEs are too high, so what they're earning, that the markets are going to go down. But that's about a 20% chance that can happen. That's why I'm telling you that there's unlikely to be a recession. Unlikely. I'm not saying that there's not going to be a recession. It's unlikely, because it's a 20% chance. Since the 50s, every single time this indicator has shown there has been a recession, but because of many other events. But the only events that were happening right now is inflation, PE contraction, high PEs, but there's a lot of productive growth. The Federal Reserve wants to have a economic expansion. Companies are investing more into their own products. People still want to consume more because after COVID, they don't want to not consume. So you see, even if there is a recession, because I'm not saying that there isn't, there could be, but there isn't sufficient reasons for that to happen, right? So what place would you rather stand? Well, I'd rather stand in the more probable that it won't happen, because there isn't sufficient amount of data that it can. There isn't sufficient amount of reasons it can't, right? But we all know that if it does happen, greet it with open arms, because it's going to give you a cheap price to buy. So since the first event in 2010 caused by stocks in the US to drop nearly 10% in just 15 minutes, known as the flash crash, often contributed to the rise of the rise of algorithmic trading, and flash crashes are now recognized as a semi-regular occurrence, sometimes affecting the broad market and other times just a single stock. In the year 2015, 2 significant flash crashes occurred on March 18 and again August 14. So now you start to see more flash crashes. So what's a flash crash? We'll talk about that in a few minutes, but a flash crash is this. where the market crashes down in a week by 20 to 15%. This didn't exist at all back decades ago because there wasn't algorithmic trading. Now you might be saying, what the hell is algorithmic trading? Well, it's the name itself. Algorithmic trading is a method of executing orders using automated pre-programmed trading instructions accounting for such as time, price, and volume. There are algorithms that execute protocols based on if the protocol was breached or executed. So that's what a lot of market makers use. You don't have a person entering data like they did in the 80s. You have machines doing that now. Now, whenever I said computerized trading or algorithmic trading, I'm not talking about retail investors because algorithmic trading nowadays, especially computerized trading back in the 80s, I'm talking about firms that are constantly clearing orders in an automatic pace by using computerized trading. That means that the person who's trading is not a person, it's a computer. Now, it's much more advanced. Now it's algorithms. Now, recently, it's with AI, right? So the more advanced technology that's filling the orders, which is really liquidating, and who's liquidating those orders, who's the firm? Those are market makers. Market makers use algorithmic tradings. They use computerized tradings before. Now they use algorithmic tradings probably with AI. And that constantly provides liquidity and volatility in the markets to sell more of the orders because they can easily fulfill the orders in matters of milliseconds because a person doesn't have to click anymore to buy or sell. It's a computer that can constantly sell orders at less than a millisecond of millions of orders. So you see, this is why as the technology gets more advanced, the more orders will be fulfilled of each direction. What that really means is that those orders, those sell orders and those buy orders of the price going down or going up is going to happen much more likely because those orders are happening much more quicker. So if many people sold in a second 1 million cells of a share, the price is going to go down instantly compared to before back in the 50s or 40s. You didn't have that computerized trading because they didn't exist back then. So what you had is the price going down, factoring in from the broker or sending it to the stock exchange, which would have took a few days, hence making the drawdown in that stock market to happen for many months. But in a flash crash, which is only existent now since 2000, let's say 2007 or 2009, now you have flash crashes like in COVID or back in 2015 or 2010, which is much more, we have more flash crashes and more likely that when the market's going to go through a bear market, they're more likely going to do flash crashes because, or anything related to finance, like bonds or such not, less of reasons economically, we're going to have flash crashes, which are going to be corrections to happen quickly because there's volatility. But what that also is that the market's going to go down faster because of that volatility. Okay, so I just want to let you know that algorithmic trading and computerized trading, there are some retail investors that do it, but because these are mass amounts of machines that are automating orders of milliseconds, of millions of orders, because that's the point of using computerized trading and algorithmic trading. So you can be the market maker, so you can fulfill those orders and have a system to make more money out of the losses in complete overall. You need to invest heavily in a machine. And of course, not an ordinary person can do that. They can't have $1 million machine. You need to have a business or a firm to do that. And that's what majority of all firms do in Wall Street. So those are market makers, right? And so this algorithmic trading provides a huge amount of liquidity to the market. So when you fill an order in your brokerage account, a broker doesn't do that. We're not in the 20s anymore. A machine fills the order and they already have an algorithm to do that. So when a machine is able to do this, a machine's more faster than a computer, especially in an algorithm. So because of this, remember before, like in the 80s where there was this big crash, now there's faster crashes with quicker bottoms because there's now algorithmic trading, and where all the orders that were filled out a minute ago are now executed only a minute compared to maybe computer trading. They were ordered 10 minutes ago and they were filled out 10 minutes later. Now it's just a minute difference. You see, so as technology gets more advanced, the more the markets have a big red candle, but that means the more likely, really understand that, the more likely that it's going to bottom. So what does that mean? If the big drop down happens, you need to make sure that you have a cash and buy immediately because it's likely to bottom because all the orders to sell were done there because they factor in all the max selling for that to happen. Think about it. If everyone is pessimistic over here, what makes you to believe that they're going to be more pessimistic over here than over here, right? It's a harder reason. Hence what's selling and that effect. It's like, think about it like this. If you scared your parents by a prank or something like that, it's harder to scare them again a minute later because they're now on an alert basis. It's the same thing in the market. When the market has a lot of pessimism, it's harder for more pessimism to drop down the market because it's harder for worse news to come in. If World War III happens, and it would be harder for the market to go down more because what's worse than World War III? You see like the logic there. So that's the same thing what goes on here. Now we're in an era where the market is super volatile because it has algorithmic trading, and where the price goes up and it shoots up and it shoots down, and where you bought low and out of nowhere it shoots up out of nowhere. That's because of algorithmic trading. And this creates big opportunities, because think about it. If you were waiting for a cheaper price, you can get delivered at a cheap price maybe the next week compared to the next month, because all the orders were filled down quicker. But that's more dangerous. You want to have more circuit breakers with that, because that creates a lot of need-ins to give cash to people who are selling in minutes. That's why now a bank run can happen in just a few minutes by digital, compared to a bank run happening in the 30s where it would happen a few months or a few weeks. Now it's just a few minutes where people can spend $1 million in a minute, compared to before, back in the 30s, maybe to spend $1 million, it would have took you about 2 days or a day. You see, the technology has advanced that, but that makes more opportunities quicker. But it's a different way to go about it now. There's more opportunities, but the opportunities happen quicker, and they don't last a long time anymore. When it happens, make sure you take it, or else it will be gone soon, because all the orders are filled there. So, but there was sluggish growth in 2015. There was red flags, just as there was last year. 2016, markets were falling hard. Negative economic reports from China caused panic selling. Interest rates fell sharply, and there were widespread warnings of deflation and depression. Interest rates fell sharply, and there were wide warnings of deflation and depression. Like always, everyone says that there's going to be a depression, there's going to be a recession, there's going to be inflation, there's going to be deflation. Regardless of that, there isn't anything worse that's going to happen. And if it does happen, so be it, but make sure to buy. And that's when the price goes up. It went up. Right? You got ups and downs, but it went up a lot. Now, you're in 2018. And in this period, this was actually the China trade war. Well, during this time, I believe this is when the tariffs happening, and this is when there was tensions of it happening. So now, fast forward, we're now in 2018. Now we're almost coming to today, guys. We're only just, wow, time passes fast, but that was about 5 years ago, 2018. I may remember that. That was quick. U.S.-China trade war was in July. Let's look at that. So, for the year overall, the economy started sluggish, picked up considerably the spring and summer, and then slowed a bit in the fall. For the 3 months, the economy grew at 2.6%. Federal government spending helped. It rose at the fastest pace in 7 years, led by a surge in defense spending. Okay, the US dollar just had its worst in more than a decade. You see, this causes people to sell. And 2018 will bring more of the same. War causes anyone to, because the market factors everything. By the time you receive, that's the thing that people don't understand. That's what happens now. By the time you receive information that there's going to be a bad event, everyone has seen it already before you. So the market has already factored the sell. So by the time you sell, that's likely that it bottoms and it goes up. And this is what 99% of people don't understand. It's what I just said. By the time you get something, everyone else has saw it. What makes you believe that you were the only person that saw this? But of course, that's always going to happen, because that's the ego of the human condition. Humans think that when they receive valuable information, no one has it. When everyone does have it, right? Everyone has the ability to become rich. Everyone has the ability to become wealthy. Just because you became wealthy does not mean that anyone else has, right? But it's funny, because humans believe like that. So Donald was worried that the dollar was getting too strong. 2018 has nothing to worry about it. This year, the US dollar recorded an annual decline for the first time in 5 years. The ICE dollar index, is always an excuse, which measures the dollar against a basket of 6 other currencies, fell nearly 10% in 2017. That's biggest annual decline since 2003, when the US dollar fell almost 15%. Now, is this a problem? No, because it's just one thing. Okay, so if the US dollar declines, okay, is that going to make Apple more valuable in 10 years? Is that going to make Amazon more valuable in 10 years? Is that going to make Google more valuable? You see, is that going to make Coca-Cola sell more Coca-Cola? No. Is that going to make more businesses sell more? No, but many people think they are. I don't know why people have an association. Well, they do. I know why, because they don't understand. As they listen to the junk that Wall Street tries to sell them. So 3 interest rate hikes by the Federal Reserve and the eventual passing of tax reforms were enough to continue the dollar's long rally. Low inflation weighed on perceptions of how high the central bank would raise, and strong economic performance by countries around the world made the dollar comparatively less attractive. This reminds me of actually what happened in 76, 77. Remember what happened after the Bretton Woods? It's the same thing, but the Bretton Woods was much worse than that. Because sometimes when people think of the past, they think like, oh my God, we're doing the same thing as the past. Everyone starts to become fearful. No, the past is not the same thing as what's going on. It was so much more worse than the past, because there was less knowing. But by nature, think about it. If you have more knowing than what you had when you were younger a year ago, what makes you believe if something bad happens again, that you're going to be worse off? No, because you know how to handle it. But many people don't understand this. Many people believe that if 2008 happens again, which is unlikely, it's hard to happen, but it will happen, but it's hard for it to happen. Many people believe that when there's signals of a 2008 to happen, everyone starts to sell because they tend to overestimate the amount of the effect, but that's because they don't understand that many of the Federal Reserve and many banks already learned so heavily of the lesson that they got. But no, people don't understand that. They believe that they're going to make the same stupid mistakes, so they factor in their emotion more than thinking. So they generalize. That's called generalizing things. You never want to generalize. 6 factors that fueled the market dive: Trump's trade war with China, the slowdown in global economic growth, and concern that the Federal Reserve were raising interest rates too quickly, all contributed to a pessimistic reaction from the stock market. That's what happened actually in 2022. The Federal Reserve rose interest rates too quickly, and that made also a pessimistic reaction. The federal government shutdown that began early Saturday had only added to the anxiety. Many of the same factors that affected the economy in 2018 are likely to continue into the next year. So, consequences of this trade war between the US and China: the authors identified 4 main reasons that led to the greatest trade conflict between the two economies in history, associated with intentions of the US to reduce the deficit of bilateral trade and increase the number of jobs, and to limit access of Chinese companies to American technologies and prevent digital modernizations of the industry in the PRC. Obviously, it's mostly political and it's mostly geopolitical. It's not something to do with companies. It's just fear that the other guy, it's like the Soviet Union, fear that the other guy is going to do more than what you do. But that's you want that competition. You don't want a war, right? Trade wars are inevitable, but you don't want a war with nuclear powers, with artificial, that's very dangerous. Because the problem is that when you have too much high technologies, you can't go back. If you bomb a city with nuclear weapons, you can't go back, right? Like, if you had a bunch of resources in that city and that city was bombed, that's it. It's goodbye. You can't fix it anymore. Everything was destroyed. It's so hard to recover. And that's why Einstein says that if the next war is fought with nuclear weapons, then the next war afterwards would be fought with sticks and stones. And that is absolutely right. And that's now Trump's trade war started with this dislike of the deficit. The legal justification was in Section 301 investigation that found American companies were subject to unfair Chinese trade practices, intellectual property theft, and forced technology transfers. Chinese officials deny these allegations. If such incidents did not happen, China has said it was on a systematic level. A punishment: Trump imposed rounds of tariffs on Chinese products, including nuts and bolts made by Jinar Star Fastener. For the additional 25% tariff on our products, our big American clients swallow most of the extra cost while we pay the rest. That was the director of that company. In the end, it is Americans who pay for most of the Trump's tariffs. So that's hilarious. What Trump wanted to do on tariffs, Americans have to pay more from the cost. That's always going to happen too. Sometimes there's going to be things that you wanted to happen and it didn't turn out as you wanted it to. At the height of the dispute, the U.S. imposed extra tariffs on 2/3 or over $300 billion worth of Chinese imports. China retaliated by placing tariffs on nearly 60% of U.S. products. China saw that this was actually a costly exercise for the tariffs are shooting yourselves in the foot and imposing costs on yourself. The country imposed tariffs selectively, while China never slapped tariffs on products it needs for economic development, such as aircraft and semiconductors. Super important. So yeah, there was a trade war with China. The markets fell down, most of all because many companies like Apple and Metaverse, where there was a lot of, you have to keep in mind that there's a lot of technology companies now that have their manufacturing and their delegation in China because it's just cheaper. Now, which I like, they're trying to transition and move a lot of the resources back to the US. And I think that's very productive because you don't want your competitors' resources to be located there, because that's going to make you very vulnerable towards any sort of legislation they give out, which will reduce the amount of economic activity. But is this a big concern for me for Apple or something like that? No. It would be a big concern if all these sales, all the value, and all the brand association of an American company was associated with China. But that's not the case with Apple. Neither is it in Metaverse. Neither is it in Amazon. And neither is it in a lot of other companies. Because a lot of their products are being sold in their brand association, their brand love is not just in China, but the rest of the world, right? So if China flipped the finger, well, we flip the finger back, and we don't need China. We don't. It's going to make us slower, but we still make more money. See, like, despite that the market went down, well, again, same thing. People who sold here didn't even know that it would bottom about a week later, and it would shoot up immediately, right? So now you have a case, which is what I keep saying, that This is flash crashes, algorithmic trading. Now you have to take advantage of these fast, sharp drawdowns and buy quickly because they're likely to go up at this big rate, 90 degrees, because there's algorithmic trading. Everyone's buying quick. They're faster buy-offs. Meaning that's why you have, this is a super valuable lesson so you guys can understand. I wish someone showed this to me, seriously, because it's super valuable. Look, if you look back 15 years ago, you can see something very different with the market compared to ever before. At least let's look at it a weekly, because it's a lot of, if you look at the market ever since, let's say 20 years ago, since 2003, you can notice a distinct difference since 2000, let's say 2013. You can see that the markets go up more in a straight line. And when they go down more in a straight line. There's less ups and downs. There's more steeper movements. Where in 2008, it was just, of course, a steep movement, but it's more of, ups and downs, and it goes down. Now you have, especially after 2016, you have a big rise, right? And this is where many people are becoming fearful, but it's because they don't understand this. This is just because there's more accurate amounts of orders being filled, meaning that all the people that wanted to buy today are actually going to be able to fully order in a minute compared to before. And so you have to understand that if the market is going up, it's likely to keep going up, and if it goes up, because everyone's buying immediately. It doesn't take days now for it to happen. There's going to be huge candles now, and where there's huge gains in one day, because it's algorithmic trading. It's happening at real time. There's no delays. So now you have to expect the market to make two things: shallow declines, and when an event happens of pessimism, very sharp declines, like in COVID, but very fast, sharp declines. Even here, if you compared this to maybe 2008, but over here, I would say that this is a pretty long decline if we're talking about algorithmic trading, but it was just uncertainty into that level, but it's a quicker bottom. That's why it bottomed here and no one thought it would. Yeah, no one, and plus it always has done that, but it bottoms quicker than it ever did before because of algorithmic trading. So it means that you have to be ready when the price is coming down, because it's a much more likely chance that it's not going to keep going down, because a lot of the selling has already been flourished, because there's already big candles. Not just big candles, but now we're talking about extremely big candles like this one, where everyone has sold trillions of dollars now in a week, not because people are more pessimistic, but because technology has allowed people to sell to that level. That's all. The sentiment has always stayed the same since 1928. It's always been the same. Only that now, when you want to sell, you can sell immediately, because technology allows you to do that, because everything's more accurate. But it doesn't mean that there's more pessimistic, and no one, this is the thing that no one understands. And I just wanted to be clear with that. You guys can understand that, because you're going to see a lot of now movements, very volatile movements, that will go up and down immediately when you didn't expect it to, because all the selling has been factored in immediately in one candle compared to immediately in 1 month, because the orders have been filled. The technology has allowed it to be filled. And so at any rate, if we go to 2018, right? So that's what happened in China, the Chinese trade war. Then 2019. Now, I remember in this year that a lot of people were worried on a big, let's say, drawdown, because the economy was stagnant. There was potential of high inflation. And I remember in this time, I was different. I was completely different from what I was doing right now. But I remember over here, I'm going to give this, I haven't told this much to people, but I remember I was predicting. I didn't have the knowledge that predicting is useless, but I remember I was predicting that the market would go down because of a lot of these events happening at once. And so it did go down immensely. But it wasn't because my prediction was right, but because coincidentally, when I thought the market would go down exactly 2 weeks, that's exactly when coronavirus happened. So the reason why the market went down immensely in 2020 was not from inflation or high interest rates, but it was because of high interest rates, high inflation, and coronavirus. When you see it's multiple reasons, and where that affected every business because everyone had to stay home, a pandemic. But look what happened: a flash crash, a crash that would last only 3 months. And I remember the Federal Reserve pumped in money immensely. They pumped in money during March 20 something. Jay Powell did a surprise meeting like what Volcker did. If you guys remember Paul Volcker from the 70s stagflation, or he raised interest rates to 20%. Well, Jay Powell did the same thing. He didn't raise interest rates, but he did the opposite. He did a surprise meeting to inject the most cash the U.S. has ever done in history. And the reason why they did that was because if they didn't do it, there would be a Great Depression. Like there would literally be a depression if that. To be honest, who knows what would have happened. But if they didn't happen, the results would have been really bad, because we're now talking an event where people can't consume, literally, because not because they don't want to, but because they can't, physically can't, because of a virus. But that didn't affect as much, because as always, people still, when you restrict them from consuming, they still want to consume more. And what happened? Something that people didn't expect, but I somewhat did. I remember in these times, I was thinking like, my God, Adobe and Broadcom and Oracle and Metaverse and Amazon are going to make so much, and Nvidia, I forgot about Nvidia, are going to make so much money because everyone's going to stay home. Everyone's going to do a lot of things at home. I already knew that by that time, and it happened. That actually became true. Instead of everyone working at their offices or at their workplace, people start, which people do now. People don't work at their offices, no need to. That all started from here. That coronavirus helped a lot of digital businesses to make billions. I mean, Zoom, I remember, was making like $200 million, and out of nowhere, they made, just in COVID, they were able to make 200 million now to 3 billion. That's crazy. It was actually $25 billion in 2020, and then in 2021, it was net income $672 million. That's a huge difference. That's an enormous gain. What other asset can do that? That's why I love businesses, and that's why I love the markets, the stock market, because I mean, where can you get an instrument that was making $200 million last year and now it's making $3 billion consistently? And it's because everyone moved to digital. Everyone did video conferences. Everyone did everything through online, through their homes, more consumption, more delegation in their homes, which provides more products for self-productive things like meditation, like self-improvement. People started to understand a lot of things about their health. So health companies went up. Of course, they went up too because of the vaccines and the circulation with the vaccines. And so after this, when a lot of people thought there was going to be depression, they were incredibly wrong, because it helped people to consume a lot of digital products, right? So then Metaverse and Amazon was the most. Amazon made a ton of money because people still need to get physical items. And where can they get it better anywhere else than trying to go into a store? Well, through Amazon delivery. And that's what happened. Now, the other reason why stocks went up was because everyone had free cash. This is what I call it. The government literally gave free cash to anyone who didn't even have businesses, just to a cash injection. You guys remember the stimulus bill? To incentivize spending, and also to help them in order to pay for things, because they didn't have jobs. Because a lot of companies went bankrupt because those were brick and mortars. So people who were working in factories can't do it anymore because of coronavirus. So they were helped with stimulus bills. But there was a lot of people, because in 2019, I remember when I would say, and I'm hilarious because I am doing that, but a lot of people, but I don't like that because it's not a productive thing. It's not good that you want everyone to move into wealth management. A lot of people want now, and it's interesting the times that we live in, but it's because of social media. Wall Street back in 2012 realized that many people don't want to be poor. And so there was a Wall Street person that decided to make a course and sell it to others to try to make a lot of money. Of course, it's a very productive thing, but it's not productive that everyone does it. Because when everyone's involved in wealth management, there isn't anything valuable to sell anymore. There isn't any engineers, there isn't anyone working in jobs. You don't want that. And so what I'm doing with here is mainly because that cause is not effective. That's why you guys have heard me said that, for crying out loud, if you love to do something, if you like to do physics, if you're good at physics, you shouldn't be in the market. You should be in physics. You should be putting all your talent in physics. However, if you want to, I believe that a lot of people should try to be financially independent, because I know how it is to be in that position. But I don't believe that everyone should be financially independent, because that's not how the world works. Or others won't be financially independent. Why? Because you need consumers. You need people consuming. You need to have a producer and a consumer. So it's hilarious because it's kind of into this factor, but that's why I always tell people that I hear a lot of people, which is complete bullshit. I don't get why people say this, but people say that, why aren't you doing sales? Or do sales because you're going to make more money, or do this because you're going to make more money. No, you make more money because you understand it, because you like it and you can increase upon that, right? That's why I tell to people again that you should do things that you want to do, because you're not going to just make money buying the markets just because I tell you to. You only make money if you really understand what I'm saying and you try to put the work that's upon in that. That's the secret sauce, guys. That's the secret that a lot of people don't try to tell you, but it's because they want to sell you continuously. They just want to keep selling you so that you can come back to the course. I'm not about that. I'm a transparent person. I think that's a low way to go about in life. And I think that's just very limited. It's not necessary. I don't have to lie to you guys. I don't have to do that because I know what I'm giving in value by transparency is enough for you guys to understand whether you like what I'm saying and whether you want to be on board with me. I know a lot of people won't be on board with me because I'm very transparent by that nature, but I think that's very important because for me, what's more important is to be more transparent than rather than trying to sell you to something. Because why would I sell you if it's not good for you? I don't. That's why I have sometimes this confliction with people who are trying to sell. Selling is important, of course. Selling is important, but it's important whether the thing is valuable for the person, and that's why I'm doing this. And so you can become independent in what you have, but it doesn't mean that you should stop doing what you're doing. It doesn't mean that you should just completely be obsessed with finance and do whatever you did. Luckily for me, I would say, right, that I got into finance because of that understanding and hearing from other people. And so I got interested into it. So of course I am grateful. I'm not saying it was a bad thing that about the wealth management and all this type of stuff, but it's not productive when you want all the people getting involved into it. Luckily for me, I wasn't already super interested into something. In fact, I was seeking for it. I was an extremely hungry person to develop something, to make something out of myself. And so I found out that that niche that I liked, that I loved, that I didn't know I loved was the markets, was investing, was finance and all this stuff. So it worked out perfectly fine. Maybe that's not the case for a lot of people, and that's perfectly fine because that's not how it should be. But that doesn't mean, that's why I keep saying this, why this is the whole point of my course. I want to give you an access to basically run an operation on each way, whether it's passively, whether it's manageably, or whether you just want to look at it all the day. That's all what this course is about. That's why I'm giving so much variety in terms of how much income you have, because I know a lot of people can't just give $100,000 to their account because they can't, or a lot of people can't even give less than that, and that's perfectly fine. And a lot of people also, even despite them having $1 million, can't stomach the drawdowns or a lot of this stuff. So that's why I have different methods for people who can stomach, like me, because I put a lot of dedication into what I'm working. I know what I'm doing. But if you can't, if you work too much, or if you just can't for any reason, that's why I say the best thing you can do is just do two things. If you want, well, we'll talk about that later. Yeah, you know what? We'll talk about that later because I don't want to start this whole thing now. We'll talk about that after we complete this. You can understand. But this is what was going on here. Everyone was entering into wealth management, and when everyone was, a lot of people got free money, and they were investing heavily into stocks, right? And into everything. And a lot of people were getting into marketing, whether they wanted to be rich and all these type of things. That's what led the market to shoot up as it did in 2021, plus with economies. But however, the consequence with this is that are companies rising or making money primarily because their product has changed bigly in value? No, they just have more cash from the government so that they can invest. That's exactly what happened in 2022. A lot of companies like Metaverse, they took advantage of this cash injection with low interest rates. They accumulated cash and they decided to say, hell, well, we can hire more employees because we have more cash, and we can actually seek much more deeper talent. And so they got talent from Google and they got talent from this, but when they realized that which we'll talk about that eventually. That's what happened in 2020. After that stimulus, of course, COVID got resolved a bit, which inevitably it did because human innovation eventually solved in things. It was a hard vaccine, but it's getting resolved. Coronavirus is still a thing right now. The funny thing is, I don't even know in the future, the people looking at this, I don't know when this is even gonna be listed exactly, but people watching this in the future are probably laughing because they probably saw this too or probably remember this. But yeah, very interesting to think about that aspect. But the coronavirus is still sort of a problem right now as of 2023, but it's not as much as a problem as it was back then over here because no one knew what the hell was going to happen. I remember I didn't know, but what I do know for sure is that these companies would go up from that. So by 2021, you basically had this free market, free cash, and free party where everyone was getting free drinks. But of course, none of that lasts for long because of this stimulus bill.